of the VAT exclusive value of the invoice of the delivered goods. So the VAT exclusive value of the invoices is 202,472 divided by 1.14 multiplied by 4%. And that gives us then a total of 71,073. Closing inventory we don't have. So that is the big unknown at this point of time. Cost of sales at this point of time, therefore, we cannot calculate because we don't know what it is. So let's see what can we further complete in this line here, where we're going to talk about sales. What other sales figures do they give us? Now, if we go back here, they said that there was special sales during the last week in November. The proceeds banked from the sale of Sealy mattresses was 66,690, so I have to take out the VAT, and the ECPO mattresses 39,900, so I have to take out the VAT. So the special Sealy 66,690, take out the VAT 58,500, and the special sales for ECPO mattresses 39,900, and I have to take out the VAT. They tell us that the total sales for the rest of the year, according to the normal sales account for Sealy mattresses, amounted to 425,400. So 425,400 in total, that is the value of the sales account, so the VAT has already been taken out. So now I have the total amount, I have special, normal, special. So therefore our first balancing figure that we can work out is the normal sales on the ECPO mattresses. And then we have built that whole thing that we have there. Good. They gave us initially our markup percentages. And based on our markup percentages, we shall be able to work out the cost of sales. We say that normally a gross profit percentage on the Sealy mattresses is 30% of the selling price and 50% is added to the cost price. So those two markup percentages that we have there is based on normal sales. But then they tell us that in November with the Black Friday sales, all the selling prices were dropped by 20%. So that means I have to adjust my profit figure for the special sales in order to make provision for what it is when I drop those figures to account for the special sales. Now, if we look at the first one, if 100 is dropped by 20%, what is 20% of 100? 20% of 100 equals 80. So that means that my purchase price, my cost price can never change. If my selling price is now 80, what is going to be my markup? Only 10. So for the special sales, we're going to have a markup here of 70 plus 10 equals 80. The normal 70 plus 30 is 100. 20% drop of the selling price gives me 20% of 100 equals 20. So what is my new selling price now? 100 less 20 equals 80. I can never change my cost price. So my cost price stays the same. If I've paid 70 Rand for an item, I've paid 70 Rand for the item. I cannot change that. So the only thing that can change is our markup on the cost price. And our markup on the cost price is now only 10 divided by 70 to derive at a new selling price of 80. If I have the sales figure, I have the 80, I can now determine what was the cost of sales. So 70 divided by 80 multiplied by our selling price of 58,500 gives us the cost of sales for Sealy's special sales of 41,187. I have my normal markup percentage, which is 70 plus 30 equals 100. So I have my sales figure of 425,400. What is the cost of sales? 70 over 100, 70% in other words, of 425,400. And that will give me my cost of sales of 297,780. For ECPO mattresses, we said that our normal markup percentage was there. 100 plus 50 equals 150. So if we're going to drop our normal sales price, which is 150 with 20%, then 150 times 20% equals 30. There it is, 30. So what was the sales price with the special sales? 150 less 30 equals 120. The cost price can never change, so the cost price stays at 100. So what is the variable? The profit percentage. So 100 plus 20 will give me the answer that I'm looking for of 120. We have the sales proceeds, which was 35,000 VAT exclusive. So if we take our selling price of 35,000 multiplied by 100 divided by 120, that will give us cost of sales of 29,167. We have our normal profit percentage, which is 150 equals 150. So we have now as a balancing figure there our sales, 2,11700 times 100 divided by 150, and that gives us cost of sales of 1,407,800. If we now add the 1,407,800 plus the 29 plus the 297 plus the 51, voila, total cost of sales 1,785,934. Now I know that opening inventory plus purchases plus purchase related costs less closing inventory, which at this point of time is the X, is now equal to an amount of 1,785,934. So there's only one unknown in that formula at this point of time. So the balancing figure we can now calculate as closing inventory 49,075. And now we can complete the picture. We can now work out gross profit, blah, 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 blah. So we know exactly what is the value of closing inventory. They tell us that the physical stock count on 28 February revealed that the cost of CV mattresses was 27,805. Now we have calculated the total value, 49,075. So what we can do now, just simply removing the CV mattresses cost, which is 27,805. And then we get the cost of our Edbo mattresses being 21,270. But that's not all. Upon further investigation, it was found that 15% of the closing inventory of Edbo mattresses was damaged and could only be sold at 50% of its original cost price. So we have to go and determine what is our net realizable value adjustment. Damaged 15% of the 21,270 multiplied, I can only get what is the realizable value, 50% of the original cost. The cost was 21,270, so I can only get 50% of that, and 50% must be written off as a NRV adjustment. So if you work that out, it means that the total is 1,595, which is our net realizable value adjustment. So our total closing inventory is going to be 49,075 less the net realizable value adjustment of 1,595. So the value of closing inventory 47,480. We still haven't answered the question. We've done all these calculations, but we haven't answered the question. The question says, prepare the inventory notes to the financial statements of Bargain Mattresses for the year. The accounting policy note and comparatives are also required. Show all your workings. So now we only have the figure that we have to use in order to complete the question. A proper heading, Bargain Mattresses. Notes to the financial statements for the year ended 28 February 2018. One accounting policy. Inventory. Inventory is shown at the lower of cost or net realizable value, and the first in first out method of valuation is used. You should have added here net realizable value is the expected selling price of inventory on hand after all compulsory selling costs have been deducted. Net realizable value is the expected selling price of inventory on hand after all compulsory selling costs have been deducted. Then, comparatives, 2018, 2017, rand. Inventory, you have calculated and you've known what is opening inventory figure, 76,700, so last year, 76,700. Closing balance, 47,480. Please note that it is after the net realizable value adjustment has been deducted. So you only show this value after the NRV has been taken into account. And then if there was a net realizable value adjustment, you have to mention the fact that there was such an adjustment. You have to mention the value of the adjustment, 1595, and you have to mention the reason for the adjustment as a result of damaged stock. And only then you have completed the full question. Guys, please go again to the question. Please see where you've made a mistake. Please rebuild the puzzle. And please make sure that you understand exactly where all the figures are coming from. Good luck. I'm thinking of you. Bye.